Right now, Nuburu Inc., ticker BURU, is trading at 39.79 cents. That is an explosive intraday move, up $0.0568 or a staggering 16.65% on the day. This is not a low-float drift. This is a surge happening on absolutely massive volume with over 112 million shares already changing hands, absolutely dwarfing its typical averages. This stock is on fire today, hitting the high of the session as we speak after opening around 32 cents. But here is the critical insight you must understand before you look at this chart and think you found a simple momentum play. This rally and the extreme volatility of the past few weeks has almost nothing to do with the company you think Nuburu is. This is not a rally based on their legacy blue laser technology. This is a complete corporate identity crisis, a desperate pivot playing out in real time, and it's one of the most complex and confusing corporate stories on the market right now. The company is fundamentally changing its entire business model right in front of us, and the market is trying to figure out if this is a brilliant transformation or a final act of desperation. Let's establish the common ground, the expectation that has defined this stock for years. The narrative sold to investors when Nuburu came public was simple. They were the blue laser company. They had this unique patented technology. Because blue light is absorbed more effectively by metals like copper and gold, their lasers were supposed to be the key to unlocking defect-free, high-speed welding. The expectation was that Nuburu would become a critical supplier for the two biggest manufacturing booms of our time, electric vehicle batteries and consumer electronics, both of which require welding massive amounts of copper. This was the story, a high-growth, high-tech, pure play on a future manufacturing need. Now, let's confront the reality, because it is a brutal contrast. That blue laser business as a standalone venture has been a financial disaster. The reality is that this company has been in a fight for its life. We are talking about auditors issuing a going concern warning in their filings, which is the official accounting language for "we are not sure this company can survive another year." We are talking about a cash balance that as of June 30th of this year had dwindled to a terrifying $111,090. Total. Revenues have been in free fall, the company has been buried under operating losses, the stock price collapsed, forcing a reverse split just to stay listed on the NYSE American, a battle they almost lost, receiving a warning letter just on October 13th for non-compliance before resolving it on the 16th. The story the market believed in simply did not translate to a viable business. So, this 16% surge today, it is not about a sudden massive order for blue lasers. It is the market reacting to a series of frantic, transformative announcements that signal the company is abandoning its old self. Nuburu was attempting a full-scale pivot to become a defense and security hub. This move started in September with a $12 million public offering, a highly dilutive but absolutely necessary capital raise that brought their cash position to around $6 million. But they're not using that cash to build more lasers. They are using it to buy other companies. On October 1st, they announced a dual CEO structure. On October 7th, they announced a binding agreement to acquire Orbit SRL, an Italian software firm specializing in operational resilience. And the catalyst for today's massive spike is the news from 2 days ago, on October 22nd, a strategic alliance with Maddox Defense to form a joint venture to go after the multi-billion-dollar NATO drone market. Nuburu is no longer a laser company. It is now, apparently, a defense, software, and drone company. This is where the short seller argument becomes crystal clear. We have to talk about the short position here because it is significant. As of the most recent data, short interest as a percentage of the float stands at 16.83%. That is a high number and represents a significant bet against the company. The bearish thesis is painfully simple. The original business failed. The company was on the verge of insolvency. This new pivot is not a transformation, it's a shell game. The bears are betting that this is just a collection of questionable assets being rolled up, funded by panicked, dilutive share offerings to create a new story to sell to the market. And they have ammunition. That acquisition of Orbit SRL, it's a related party transaction. The company is acquiring it from a firm wholly owned by Alessandro Zamboni, Nuburu's new executive chairman and co-CEO. The optics on that are, to put it mildly, terrible. What's your take on the 16.8% short interest? Is it a smart bet against this chaotic pivot, or are they underestimating this new defense angle? But here's where it gets complicated for the shorts. This is not a classic low-volume, high days to cover squeeze setup. In fact, the days to cover ratio is a tiny 0.08. That's not a typo. It's near zero. This is because the volume is astronomical. With 112 million shares trading today alone, anyone who wants to short or cover their short position can do so instantly. This isn't a liquidity trap. This is a high-volume, high-volatility battlefield. This is algorithmic traders, day traders, and retail speculators jumping on the defense and drone keywords and battling it out with shorts who see a company with negative net equity and a history of failure. It's pure chaos. For investors trying to navigate this, you need to know what to track. The first thing is to understand that a high short percentage without a high days to cover ratio is not a squeeze signal. It's a high conviction bet against the stock, but one that is very liquid. The key data point to watch, which you can find on platforms like Fintel, is the off-exchange short volume. For BURU, this number has been consistently high, frequently over 50% or 57%. This means a huge portion of the bearish trading is happening in dark pools, away from the lit exchanges, which can mask the full selling pressure. You should also monitor the borrow fee rate. Right now, it's at a moderately high 9.16%. That's expensive, but not extreme. If that rate suddenly spikes to 50% or 100%, it would signal that shares to borrow are becoming truly scarce, and that is when the squeeze potential would become real. So let's quickly recap what this company was versus what it is. The old Nuburu, the one that still dominates its corporate website, was built on that blue laser idea. The science is sound. Blue lasers are objectively better for welding copper, which is a notoriously difficult material for traditional infrared lasers. This was supposed to be their key to the EV, e-mobility, and 3D printing markets, but they couldn't scale it, they couldn't sell it profitably, and the cash burn was just torrential. The new Nuburu, the one that exists as of October 2025, is an acquisition vehicle. It's a holding company for a new defense and security hub, a blue laser division that is now an afterthought, an Italian SaaS company acquired from its own CEO, and a new joint venture to build drones. This is one of the most drastic corporate pivots you will ever see. Naturally, the retail sentiment is all over the place. If you look at Reddit or X, you will find the two extreme camps. There are the momentum traders posting screenshots of their 100 or 125% gains from the 12-cent lows in September, calling for the next big run. Then there is the other camp, the ones who have been here longer, who are warning everyone that this is a classic penny stock pump and dump. They point to the reverse stock splits, the endless dilution from offerings, and the going concern warning as proof that this is a fundamentally broken company just finding a new narrative. This brings us to the future outlook and the central tension between expectation and reality. The new expectation, the one the company is aggressively pushing with its press releases, is that it can become a player in the $3 billion operational resilience market and the even larger NATO defense market. The company is projecting revenues from its new acquisitions and joint ventures, painting a picture of a new, diversified, high-growth tech firm. The reality, however, is that this is a company with a market cap of around $50 million that had $6 million in the bank a few weeks ago and is now on an acquisition spree. How are they paying for this? How much cash is this new, larger, more complex operation burning through? The biggest risk here is no longer that their lasers don't sell. The biggest risk is dilution and execution. The company has to prove it can integrate these new businesses, generate real, non-related party revenue from them, and do it all before the $6 million from the last offering runs out, and they have to go back to the market for more, further diluting shareholders. The upcoming earnings report will be one of the most important in the company's history. No one will care about laser sales. Everyone will be looking at the balance sheet, the cash burn from these new segments, and any guidance on actual non-related party revenue. Comment below with what you think is the bigger red flag, the going concern warning from the last quarter, or the new co-CEO using company funds to acquire his own private company. As we head into next week, the signals to watch are all about volume and insider activity. This 112 million share volume day is not sustainable. It's a frenzy. What happens when it dries up? If this volume disappears and the stock is still trading near 40 cents, the 16.8% short interest becomes a much heavier weight. The price could collapse just as fast as it rose. This surge is being driven by news and speculation, not by institutional funds building a long-term position. The other thing to watch is the Form 4 filings. With the stock popping this high, will insiders, especially those from the newly acquired companies or the new management, be filing to sell any of their shares? That would be the ultimate signal. In the end, Nuburu is a fascinating and dangerous case study of expectation versus reality. The expectation was a clean, high-tech story of a single world-changing product. The reality is a messy, complicated, and incredibly high-risk corporate restart. The company is trying to buy its way to survival by bolting on defense, software, and drone businesses. Today's 16% surge is not validation of this new model. It is pure speculation that this gamble, against all odds, might actually pay off. The line between a visionary pivot and a desperate Hail Mary is very thin.